Good morning. It's Thursday, July 8th, and what a day it is setting up to be. I don't mean to have this big smile on my face, but once we talk about it, then you'll understand, because it's going to present an opportunity, or at least it's going to be the beginning of what I suspect is going to be an opportunity that we've been talking about for months, which finally may be knocking on our door. So let's talk about it. I'm Kenny Polcari, host of The Party, your morning market commentary, everything you need to know to get the day started. And so what happened yesterday when the Fed came out and made their announcement? What did the markets do? The markets kind of been hovering all day. They were a little bit higher after the Fed came out. They ended up marching higher. Once again, the S&P closing at a record high on the back of what the Fed said. But what did the Fed say, right? They took the stage and they hinted at a possible change. Markets closed higher yesterday, but this morning they are rethinking that move, right? Global markets all under pressure. European markets down better than 2% as the morning gets started here in America. U.S. futures are pointing to a bit of a struggle today. But what are we having for dinner? We're going to have this one's easy, salmon and a lemon dill sauce. You can eat it for dinner. You can serve it for Sunday brunch. It's a great weekend dish if you're going to have people over on a Sunday brunch, right? So good morning, good afternoon, and good evening. What a day it is shaping up to be. Global markets are getting slammed and U.S. futures are under pressure. Now let's just go back for a minute and revisit what happened yesterday when the Fed took to the stage at 2 o'clock to announce their June minutes from the meeting, right? While there was no official change in plan, the tone has clearly changed. You see, like I said, there've been some officials, I've been saying it all along, that want to see the end of this bond buying program, while others continue to emphasize patience. And yesterday's big reveal suggested that they, quote, might need to pull back their support for the economy sooner than they anticipated because of stronger than expected growth. Go figure! And while they're not ready to stop serving up the Kool-Aid just yet, there are a bunch of them that think that the time is approaching. So you need to read between the lines here, right? Stick with me, kid, right? Read between the lines. Various participants mentioned that they expected the conditions for beginning to reduce the pace of asset purchases to be somewhat earlier than they had anticipated at previous meetings in light of the incoming data. What have we been saying? Do you see where this is going? And while Jay attempted to make it clear that there's no change yet, the sense is that the pressure is building on Jay. And while some in the group may appear to support the status quo, there are cracks in the foundation. After the report came out yesterday, there wasn't much of a reaction, right, in either direction. Stocks were up small going into it, but there wasn't like a visceral reaction one way or the other, right? People were just trying to interpret it, read it, understand it. In fact, bond yields continued to tumble, stocks continued to rise, and by the end of the day, the Dow added 104 points, the S&P gained 15, then closing at a new high. The Nasdaq eked out a 2-point gain, the transports rose 80, while the Russell lost 21 points in a foreshadow of what's happening today. The algo's pushing hard, causing the indexes to notch new highs, like I said, right? But then something happened overnight. U.S. markets closed, the sun set over the Pacific, but yet it started to rise over the east coast of Asia. And suddenly markets were met with sell orders. Surely there must be a mistake. Sell orders, there should be buy orders. Well, it began in Hong Kong. Investors there were now worried about this new Chinese regulatory efforts targeting big tech and U.S. IPO listings. Think Didi is the latest victim in China's efforts to control the data. Tencent fell 3.7% on top of the 2.4% it lost on Wednesday, and that stock is now down 28% from the February highs. Alibaba lost 4.7% on top of the 1.7% it lost on Wednesday, taking that stock down more than 34% from its highs. Didi gave up another 4.5%, leaving that stock now down 13%, and it's only 3 days old. And the list goes on. Hong Kong markets fell by nearly 3%, Japan down 0.8%, China down 1%, while Australia managed to gain 0.2%. Stocks in Europe are no better. Markets there are under pressure across the board. When I started writing it, the average losses were about 1.7% across the ranges. Talking the latest variant of the COVID virus supposedly behind the moves, to which I say baloney. The negative tone out of Asia is causing the angst in Europe. The idea that the Fed may have misjudged the extent of the robustness of the recovery is fueling the move lower. How long have we been talking about this? And how long have markets just kept going higher and higher and higher without any correction or pullback? So today we're getting what may be the beginning of a proper pullback, and everyone's trying to make it into something it's not. As if the bottom's going to fall out, as if the Fed and every other central bank is suddenly changing their policy. They are not. All they are doing is hinting about it. They've been hinting about it for weeks now, and they hinted again. So wake up. U.S. futures are down, and they're down fairly big. U.S. Treasury yields are also down big, currently yielding 1.27%, right? As prices rise, and the yields go lower. As the move into the safety trade gains momentum, it has absolutely nothing to do with the latest COVID variant. Absolutely nothing. It's a convenient headline for sure, but let's be serious. Has nothing to do with that. The move is a realization that the hints that the Fed has been floating for a while, right? Sooner tapering and higher rates, a la James Bullard and Bostic and others, is much more of the reality, right? The minutes all but reveal this. Read them, listen to them. Listen to your own gut. What is it telling you? Mortgage-backed securities, right, are under fire. Why are we still supporting an overheated housing market? Why is the Fed still buying $40 billion of mortgage-backed securities every month? Is the housing market faltering? What am I missing in this, right? Maybe if we stop buying a lot of these mortgage-backed securities, we'll see the mania start to slow down. Jimmy Bullard brought this up, right? It doesn't mean we're going to stop building houses. No, it just means that maybe the hysterical 30% increases every 6 months is going to slow down. And rightly so, because people who need to buy houses can't buy houses. Starter homes in South Florida are $1 million. Starter condos in New York City are $1 million. Seems to me something's way out of whack here. I don't know. You make your own decision. And then there's the China story. There's the Russia story. There's the OPEC story. There's the Afghanistan story as we pull out of Afghanistan. There's the DC story all about infrastructure. There's the coming earnings story. There's the debt limit showdown that's going to come on July 31st. And this is an issue that the market is not paying any attention to. As of July 31st, the government cannot sell any more bills, bonds, or notes unless, of course, someone starts to pay attention and they raise the debt ceiling, which, of course, will happen. But at what expense? What will those negotiations look like? Whose feet will be held to the fire? Right? That's a conversation, quite surprisingly, is not even on the front headlines, right? No one's even talking about the debt ceiling that we're going to hit in 3 weeks in the middle of earnings season. As the Fed's in the middle of all this negotiation. In any event, expect to see a down day today, right? At 6:15 this morning, Dow futures were down 500 points. S&Ps were down 60, Nasdaq's down 200, the Russell's off by 40. European markets have now fallen further, and they're down better than 2% across the board, something I expect to see here. But don't make an emotional decision. Do not panic. This is well within normal. In fact, we could see the markets actually decline 9%, and it would still be considered within normal. Now, you don't want to see it go down 9% in one day, but within 9% is considered normal. So sit back, we discuss this. I've been saying it for a while, and now it's starting to happen. So just hold on. Hold off on new purchases, or at least bid lower if you want to. The algos are anxious. You can feel it. They're unpredictable. They don't talk. They don't understand the tone. All they do is operate on mathematics with zero emotion. And when they're in sell mode, stocks weaken. Buyers retreat, which causes sell algos to get more aggressive as they target to raise a certain percentage of cash. As prices go lower, they have to sell more stock in order to raise that same amount of cash. Capiche? So just sit back. Don't get nervous. It's not the end of the world. At some point, the buy algos then realize they take over and recognize the mispricing that's happening. Again, the pendulum always swings too far left and then it swings too far right as the markets become anxious. It's true in any situation, right? The win now is for the long-term investor not to panic and to recognize the mispricings when the stocks go on sale. So beware. I said this, when you change the inputs of the equation, then you're going to change the outputs or the results. And the Fed is changing all the inputs, right? So valuations are going to have to change. Risk parameters are going to have to change. Estimates are going to have to change. Earnings season starts in 1 week, and earnings are expected to grow better than 40% this quarter. Some estimates have as high as 60%, and that too is unsustainable. So don't rush. We talked about this. This morning, the 10-year is hovering at 1.27%. The VIX is up 30%, trading at 20.85. Remember that whole complacency argument that I gave you only days ago when the VIX closed at 1507. Gold is up $6 or $7 at $1,808 an ounce. Oil is down 80 cents, trading at $71.50 a barrel as the OPEC drama continues and the broader tone remains anxious. So everything's kind of like in this sell mode. But don't expect gasoline to crash anytime soon. That is not happening. Eco data today includes the usual initial jobless claims and continuing claims, both a non-event considering the tone of the market this morning. Bitcoin is down nearly 6%, trading at 32,000. Ethereum is down 7.7%, trading at 2180. And Dogecoin is down 8%, trading at 20 cents, 20 and a half cents. The S&P closed yesterday at 43.58, another closing high. Go figure, right? Now that the FOMC minutes are out, investors are beginning to reprice the risk and preparing for the start of earnings season like we've been talking about. Expect volatility. We talked about this. I've been saying it. The talk of some big fund making a big negative bet on the markets today is nothing to be alarmed about. Consider this. If the fund has billions of dollars in equities under management, then the big negative bet is just a risk management tool to help protect that portfolio. Do not get caught up in what some in the media are trying to define as anything but hysteria. It is not. It's good risk management. Look at what you want to buy. Make that list. Make the shopping list, right? Get ready to act on it. Tweak where you need to. Talk to your advisor who's always happy to help. The current S&P channel remains, just like I told you, 4226, 4400. As long as we trade within that range, it's all considered normal. So while it might get uncomfortable, don't get nervous. You know what you can do? You can text the word invest to 21,000 to get my digital business card. Feel free to download it. Text me, email me, give me a call. I'm happy to discuss the markets. I'm happy to discuss what's going on today. I'm happy to discuss what might go on tomorrow. And you can always catch me on Twitter. It's just my name, right? So my handle is @Kenny Polcari. You can get me on Instagram. It's KennyP1961. And as you know, if you're watching this, you can always catch me on YouTube as well. So what are we having for dinner tonight or for brunch on Sunday? Because this is a great Sunday brunch, right? It is summertime. It's perfect. Salmon and a lemon dill sauce. It's very simple to make. You need a nice piece of salmon fillet. You can either, like I said, you can eat it right out of the oven if you want to eat it for dinner one night, or you serve it up for a Sunday brunch as part of the Sunday brunch table, right? But for this, you need 1.5 cups of mayonnaise, a half a cup of Dijon mustard, not yellow, right? The brown kind of grainy mustard. You need a teaspoon of lemon juice, 2 teaspoons of horseradish. You need garlic cloves. You need a 1/4 cup of fresh dill, must be fresh. Salt and pepper to taste, and like a 2-pound salmon fillet. You start by seasoning the fillet with salt and pepper and then just set it aside. In a bowl, you want to mix all the ingredients, the mayo, the mustard, the lemon juice, the horseradish, the garlic, salt and pepper, the garlic, and then salt and pepper to taste, and add the dill. Spread the dill mayo sauce over the flesh side of the fish. Bake skin side down, right? So put it on the flesh side, put the skin side down, bake it in a 350-degree oven until it's done, right? And the salmon doesn't take long to cook. Remember that. Depending on really how thick it is, maybe, it might be in there 10 minutes. Depends on how you also like it, right? I like it kind of medium. Other people like it more well done. Other people like it a little bit undercooked. So, you know how you like it. So just keep your eyes on it. Once you pull it out, if you're having it for dinner, pull it out. You're going to cut it into slices. You're going to serve it with, a big salad and a vegetable of your choice. If you're going to use it for Sunday brunch, you can make it right then that Sunday morning. You can serve it again right out of the oven. You can serve it even if you make it earlier in the morning and then you serve it at brunch time at 11 o'clock and it's room temperature. It's perfectly okay. Just don't make it cold, right? Take it out of the oven, cover it if you're going to serve it for brunch. If it goes to room temperature, it's fine. You're going to slice it. You're going to serve it there with everything else on your brunch table. So you're going to have muffins, you're going to have croissants, you might even have bagels, English muffins. You'll certainly have eggs, you'll have roasted potatoes, maybe even bacon and some sausage. You'll have a big salad, because at brunch you should always have a big salad, a big green salad as well, for those of us who are trying to be really, really healthy. And in the meantime, look, the day's about to get started. Markets are under pressure. It's going to be an exciting day or two. And so let's just stay focused. In the meantime, take good care, and I'll see you in the morning.